Hi everyone, and welcome to the NOVACYT Group investor presentation. Over the next few slides, we're going to introduce the presenting team to you, which is just not myself and Steve today. We're going to bring Joe Mason inside the group to talk about our new product introduction, and Maria Waters, our new Chief Commercial Officer, to explain the route to market and commercialization strategy. But before we do that, we're going to go through the full year 25 interim results via Steve. I'm going to take some time out to talk a little bit about the background of these two businesses that are joined together. I'm cognizant that we haven't really spoken to the market and given much updates over the last 18 months. So today is all about understanding where we were, understanding where we are today, and where our plans and ambitions hope to take us in the future. And as I mentioned, we're going to have Maria talking through the growth levers and Joe talking through the new product introduction strategy. Steve will then finish up with our financial outlook for the business, and I'll give a quick summary before we bring the presentation to a close. For those of you that don't know, my name is Lynn. I'm the CEO here at NOVACYT. I've been in the global diagnostics business for over 26 years now. So I first joined in 1999. I've worked on a range of platforms, including lateral flow test, PCR, and more recently with the Yourgene and NOVACYT Group next-gen sequencing. And I look forward to using all of those years' experience to helping this business develop its plan and achieve its expected outcomes over the next 3 years.
Thanks, Lynn. Good morning, everyone. My name is Steve Gibson. I'm the CFO at NOVACYT. I've been with the company now for around 8 years. And prior to that, I spent over 10 years at Hewlett-Packard in a variety of different roles.
Good morning, everyone. My name is Maria Waters. I've been with the NOVACYT Group for 1 year. Previously, I've been in diagnostics, life science research, etc. for the previous 20 years.
Good morning. My name's Joanne Mason, and I'm the Chief Scientific Officer here at NOVACYT. I joined Yourgene back in 2019 and then moved over to NOVACYT as part of the acquisition. My background is in modernising molecular diagnostics, and I've spent the last 20 plus years working within the NHS and private companies, introducing new diagnostic assays based on PCR and NGS technologies.
Okay, so now that we've met the team, I'm going to hand you over to Steve, who's going to talk through the interim results.
Right, so we're going to kick off with the financial highlights then of the interim results. So H1 revenue totaled £9.8 million, which was slightly down on last year. However, when you strip out the impact of the Taiwanese laboratory divestment, so that we're comparing apples with apples, revenue has actually grown by around 2% or 4% on a constant currency basis. And we saw 3 consecutive quarters of growth from Q4 2024 through to Q2 2025. Gross profit was broadly flat at £6.5 million when you exclude the impact of the DHS settlement that occurred last year. Gross margin remained strong, and we delivered a healthy 66%, helped by consistent sales of our PCR range of products, which saw Primerdesign deliver a gross margin of over 80%. And from an EBITDA perspective, the group reduced its losses by over 20% compared to last year, delivering a loss of £4.1 million compared to £5 million. And that was mainly as a result of reduced operating costs. Now, if you move to look at revenue in a bit more detail, the product mix remains fairly consistent year on year. So our clinical segment delivered around 70% of our total group revenue, or just under £7 million. Now, within this segment, NIP Technologies was up over 10% year on year to £2.4 million. RUO delivered around a fifth of our total revenue, or £2 million, and remains our cash cow of the business. And instrumentation delivered the remainder, around 10%, and this predominantly covers our Ranger portfolio of instruments. From a business unit perspective, Yourgene delivered sales of around £7.5 million, and Primerdesign delivered just over £2 million. Now, if we look at revenue from a geographic perspective, we remain well balanced and have a diversified income stream, and we're not relying on any one region. Our largest region is Europe, and that delivered sales of over £5 million. And if we dig into it a little bit deeper, our domestic UK market, which is where we have our largest commercial presence, delivered sales of over £2 million. And Asia Pac continues to grow. It grew at over 9% and delivered almost 30% of our total group revenue, or just under £3 million. And that was due to the continued strong demand for our reproductive health range of products. Now, if we move down the P&L a little bit further to operating costs, they decreased to £10.6 million compared with just over £31 million in the prior period. And that was inflated as a result of the £20 million bad debt write-off following the settlement with the DHSC. Now, if we strip out the impact of this one-time entry, it means that our underlying OPEX costs has decreased by around 800k or 8%. So we continue to make good progress reducing the cost base of our business. Now, from an EBITDA perspective, as I mentioned earlier, we've reduced it by around 20% to £4.1 million. Now, in addition to the EBITDA loss, we incurred exceptional costs totaling just 800k, and that's down from £8 million last year. And within that number, it included the £5 million DHSC settlement. Now, the majority of the costs that we incurred this year related to site closure costs as we closed 3 facilities and rehoused all manufacturing into our new HQ and Centre of Excellence here in Manchester. So this meant overall the group reported a loss after tax of approximately £6.3 million for the period. Now, if we move to the balance sheet, you'll see that there hasn't been any real material changes since the end of the year, other than a reduction in our cash position. And I'll talk through that shortly. So inventory has increased slightly, and that was to ensure that we meet the current and future demand for our key products, including our recently launched LightBench Discover instrument. And from a cash flow perspective, we consumed around £6.8 million of cash in the first 6 months of the year, and we closed with just under £24 million in the bank. Now, this cash outflow included around £1 million of exceptional costs that will not be an ongoing expense, and there was also a negative FX impact of around 300k. So if we remove these two items, the underlying cash burn in H1 was around 900k per month. That was a quick run through of our interim results, and if you'd like to see further details, please visit our website.
Okay, thanks, Steve, for sharing the interim results. I thought it was really, really important to spend a bit of time talking about where the businesses had come from. You know, NOVACYT and Yourgene were very different businesses in different sectors of the market with different shareholder bases. And since these businesses have been brought together, we haven't really had the opportunity to explain, you know, what they were, what they are now, and where they hope to become in the future. And today we're looking to do that. So I think the take-home message for me on this slide is that this business is no longer a pandemic company. For those shareholders waiting for the next, you know, wave of COVID testing or significant, you know, orders being placed on our business because we're in a pandemic, I mean, I hope for the sake of our country and the people that live in it that we don't have another pandemic like COVID. But as an investor myself, I wouldn't invest in a business on the expectation that there will be another pandemic. And I think it's really important to explain what the businesses were before that pandemic hit. You know, and in Yourgene's case, we were a growing clinical diagnostics business that had had successive revenue growth year on year. We'd had a history of buy-in growth as well. So we bought businesses in Taiwan. We bought a business in Manchester that gave us PCR capability. We bought some technology from Vancouver, along with some other customer bases, including France and the UK research market. We'd grown the business to a market cap of 100 million by successively growing the revenue each year organically and inorganically, and working with a host of blue chip partnerships across the global industry. The COVID pandemic happened and the business pivoted to COVID. We had capabilities for genetic sequencing. We had capabilities for testing. And as the rest of the market shut off, we opened up for COVID. What the effect that had, you know, I think the COVID tailwinds were certainly beaten by the COVID headwinds when the pandemic ended. Cash flow declined as the company had invested in facilities, resources, infrastructure, stock, and they were kept open in hindsight for too long because, you know, even though the commercial reality of COVID stopped overnight, everyone kept talking about new contracts, you know, new lockdowns, new pandemics. So the cash flow declined. Access to global markets such as America, which was a key focus for Yourgene pre-pandemic, became really, really challenging, with customers signing up to long contracts just to secure raw materials, making it very difficult to displace technology. And as our cash becomes squeezed as an organization, we decided to reduce our budget for R&D. So having made significant gains in markets like pharmacogenomics with our DPYD assay, we then found our market-leading DPYD assay wasn't as cutting edge as it was when it was launched. And with limited new product introduction, the business was not having new conversations with our customers and looking forward to new product launches. On the other side of the table, if you look at the NOVACYT Group, that business was a strong reputation and a growing customer base in research use only qPCR kits, with lots of sort of non-profit and non-government organization partnerships. The COVID pandemic happened and NOVACYT was one of the few product companies, if not the only company, that had the SARS COVID assay, and revenues just rocketed. Multi-million pound contracts won, lots of money in the bank, products being sold globally, and a share price raging from pennies to pounds almost overnight. Post-pandemic, that left the business with the same set of core products and portfolio of products that was there beforehand. A DHSC legal case that was well documented, that has now thankfully been settled. £100 million in cash, roughly, and an unsurety of where to focus as a business, because it was quite clear that the market didn't want another COVID, couldn't afford another COVID. And so NOVACYT kind of went back to where it was. And for any of you that followed the company, you'll understand the size of the organization and the value of the organization. So when you look at those two entities together, you had one entity with a lot of story and no cash, and one entity with a lot of growth historically over a very short period of time. But with that coming to an unpredicted immediate end, not much story, but a lot of cash. So you put the two businesses together, and I think effectively you had the perfect fit. And where does that lead us as an organization today? So, we spent the last 18 months being quiet and probably frustrating our shareholders, because we've spent a lot of time reducing our cost base. And you've got to take your time to do that. When you're closing sites, when you're right-sizing operational footprint, when you're picking your best team to move forward as an organization, housed in a new centre of excellence in Manchester, you take your time with that. And we've done all of that heavy lifting. Steve has talked through the numbers and the savings that we found as a result of that. And we continue to be savvy with our money moving forward. As you see in this statement, the headcount has reduced from January this year. We were about 240. And despite the business growing in that period, we've reduced the headcount down to 219. Our key products that Joe and Maria have talked about have hit their key milestones. Normally in our market, that's about getting regulatory approval or reimbursement, an ability to sell a product and someone that's willing to pay for it. And those new products have shown encouraging growth with collaborations and product enhancements set to drive future growth. We haven't just started investing in R&D. We've been doing it for about 18 months now. And some of the products that Joe and Maria will talk about are as a result of that investment. So we're not asking you to back a plan that we've not yet launched or rolled out. We're in the middle of this plan. And as I said, I'm delighted with the products and services that we're launching as a result of that. That £2 million incremental spend was on top of additional or existing R&D spend. So it really is a strategic investment for new product launches over the next couple of years. And again, we're on plan with our launches that we plan to put out in the market in 2025. And those products have been very, very warmly received by the market. We believe the business is de-risked and well-funded to reach EBITDA profitability using current cash balance. We're not going to be coming to the market and asking for cash to keep the doors open. We've got a stable, recurring revenue base. We've just delivered, as a business, our fourth consecutive quarter of growth as we finished Q3 25. So we know the direction that we're going in. We've spent a lot of time making sure that we're right-sized. And it's good to see those results coming through now with this incremental growth that we're seeing each quarter on quarter as a combined business. At the same time, we strengthened the board and the executive leadership team to make sure that we had no gaps, to make sure that we had the right level of experience and competences in the leadership team and the right level of challenge from our board as we navigate through, the post-COVID waters in the global diagnostic marketplace. In terms of our sort of new products and how the business is structured and set out, you'll see there's sort of 4 key pillars to our organization on the left-hand side of this slide. We've got our precision medicine and reproductive health pillars. This is our clinical market, and you see on the right-hand side of this slide, 70% of our revenue comes from these 2 areas. Reproductive health and precision medicine are 2 of the fastest growing market segments within our space. So we've backed ourselves to invest and to take advantage of our existing market share and market reputation in 2 of the fastest growing parts of the diagnostic marketplace. In addition to that, we have our non-regulated market, our infectious disease market, where we look to provide products for humans, vet and health, food and agriculture. This is the old NOVACYT business. This is research use only business. It's a smaller or a lesser regulatory hurdle to get over. You tend to have a lot more products in this side of our business. We've got over 2,000 products just in infectious diseases. And it's a bit like a cash cow. You know, it's never going to grow at a huge rate. I think the market grows at about 6%, but it's very high margin, very established business. So if you think of that as the sort of cash cow of the organization, and then we have the clinical pillars, which we would really expect to grow, and we've seen a lot of continuous growth from over the last couple of quarters, as those products become more established from a reimbursed perspective or from a regulatory perspective. Underpinning all of this is our instrumentation range of products. So machines and equipment that can be used to run more samples more effectively, can be used to take out human error through automation. And it's a part of our business which represents about 10% of our revenue, but gets us into the door of a lot of our customers and blue chip organizations that we want to work with. And I think that's been highlighted by the launch of the Lightbench Discover, our brand new platform, which is going great guns after only sort of 2 months in the market. So what I hopefully have presented to you there is a bit of history to say how the businesses came together. You know, a real strong statement that this is not a pandemic organization. We're a business that's looking to build a portfolio of clinical research products that are backed up with a platform of instrumentation to continue to grow and help and support patients making good, early informed clinical and healthcare decisions as we look to grow our market and our customer base. All of this can be done with existing cash that we have in the business on our organic plan. And as we go into the sort of final slide, there is also the opportunity to accelerate that plan by looking at M&A from an inorganic growth perspective. You know, our business plan is quite well established now. We've got clear routes to market because we've been serving a lot of customers for a long time. We're going to back that route to market and continue to excite and delight those customers by putting new technology in their hands. And that's the MPI strategy. And we're going to work with big blue chip partners or market leading partners to get the right clinical data, to publish the right scientific papers, or just to create more awareness for our products and our services. And we fully believe that that organic plan, which, as I say, started in H2 2024, so is already a year kind of, you know, in reality or in practice now, is starting to bear the fruit that we expected it to. And we've got confidence that that plan will take us to profitability on the base case of organic strategy. As I've just mentioned, though, if we want to accelerate that, there will always be opportunity to go for inorganic growth. The market for M&A has changed. There were very high prices for assets post-COVID, where organizations had seen rises in their profitability and their revenue. The market is a lot more balanced now, and I would say it's more of a buyer's market, and it hasn't been that way for a long, long time. So we keep an active eye on opportunities that can accelerate the company's path to profitability, because we could accelerate the timescale by working in the organic growth sector as well as the organic growth sector. So I'm going to hand you back now to the team to talk in a bit more detail about some of the programs and projects that they're running to deliver this strategy. And I'll come back after Steve's finished his numbers just to give a final summary on today's presentation.
So as we look at the organic growth levers for the organization, the strategic house is really a foundation of the commercial and operational success. It virtually captures the core pillars, the enablers, and the outcomes. The foundation is really built on our people, on core values, partnerships, and a customer-centric organization. The pillars represent the strategic drivers, such as innovation, channel optimization, and digital enablement. When we move up to the roof, this is really our long-term overarching goals, which ultimately are sustainable growth and profitability. The first pillar, No More, is really focused on a project that we initiated at the start of this year. It's a market visibility project. That project really leads us to data-driven strategic decisions. And it really digs down quite deeply to a contact level knowledge of specific markets. That has led us to unlock new value streams, to expand new product adjacencies, and we've already seen an increase in the pipeline, which will accelerate our commercial momentum. As we look at the second pillar, we are really looking at the execution, productivity, and deep market penetration. And this really factors in 2 points. The first one is targeted market segmentation, and this flows from the first pillar. With those targeted market segmentation down to granular level, we've increased share in high growth regions with a focus on converting competitive accounts and expanding into unpenetrated market verticals. Secondly, there's a focus on annual recurrent revenue. And how do we expand the annual recurrent revenue? Our current razor blade model is actually driving the pull through for each of the instruments that are sold. However, we've expanded those use cases, and that will increase the lifetime customer value and also produce predictable revenue streams. And then the last pillar that you see here is purposeful innovation and customer value, which Joe Mason, our Chief Scientific Officer, will go into more detail later on. This slide really illustrates our strategic agility in terms of driving that market expansion. So this year, we've really demonstrated our ability to pivot, leveraging our core capabilities, which is expanding across the globe, resulting in significant commercial gains. So here are 4 examples of what we've done this year. Proactively anticipating global shifts in the NIPT reimbursement market means that we've secured key clinical sites, sustainably growing share in the NIPT segment. Secondly, we've done exactly the same thing in pharmacogenomics, and in this instance, we've developed really close relationships with key opinion leaders, and that has given us the competitive advantage to be prepared for the reimbursement within Australia of DPYD in November of 2025. And then lastly, through leveraging multiple go-to-market models, we've been able to swiftly capture share in high-value segments such as cystic fibrosis. So all of these things, the 4 aspects just described, contribute to annual recurrent revenue expansion. Now we move on to optimizing the market reach. Our scalable go-to-market model is a key driver of our success. As we grow, we remain focused on resource allocation and relationship management, but there is strategic trade-offs here, and we are aware and recognize those operational trade-offs, because the more distribution points you have, the more resource it takes. So we remain focused on reach. That's absolutely essential, but it must be balanced with partner engagement and the internal capacity to drive those results with each of the partners. So this year we've launched the distribution optimization program. We've assessed all of our current distribution network, and we've identified partners to fill strategically both those capability and geographical gaps. And that ultimately has increased the productivity of the team, leading to a more profitable and predictable growth. Additionally, we have launched a new e-commerce platform to support the growth of our primary design portfolio. And this has broadened our market access, and it makes it easier for customers to do business with us. Now we move on to strategic partnerships. So from a strategic partnership point of view, we've actively been building and leveraging strategic partnerships to do three things. One, to accelerate growth. Two, to enhance our offerings. And three, to expand our market reach. We have deep capabilities within this organization and expertise within genomic medicine, reproductive healthcare, oncology, pharmacogenomics, and infectious disease, meaning that we are really well positioned to win in these markets. The creation of the Centre of Excellence here in Manchester has integrated the research and development function and the operations function in Manchester. And with a strong regulatory track record, we can offer a comprehensive service to partners from SMEs all the way up to blue chips, from assay development and validation to clinical testing and genomic services. So this year, what initiatives have we developed in regards to partnerships? The partnerships that we've developed this year actually span right across from clinical to research use only, all the way through to instrumentation. And in regards to instrumentation, we've successfully launched the LightBench Discover. This is a compact 3-in-1 versatile instrument offering customers workflow efficiencies, versatility, and also accelerated time to result. With a strong pipeline of opportunities, we're well positioned to drive long-term sustainable growth. Secondly, we're leveraging our deep expertise in PCR kit design, development, and manufacturing. We're developing high-value partnerships with platform providers. These collaborations and partnerships enhance our competitive positioning. And we've built tailored content for those organizations to use on their existing systems. And this really offers them competitive advantage in the marketplace. Lastly, we're looking at responding to the market needs with flexible commercial models. And that's from licensing to OEM agreements. And our flexibility to serve the market has really led to commercial success. In reproductive healthcare, we're exploring collaborations to accelerate our time to market and also increase our share in high growth markets. So you see this low touch, high touch model, when you look at e-commerce and then you move to the high touch with your partnerships, we are improving the productivity of the commercial team whilst we're expanding that market reach and we're accelerating the commercial momentum. And now I'll pass it over to Jo Mason.
Thanks, Maria. So now we're going to talk a little bit about the new product strategy and the road to profitability. In 2024, the NOVACYT board agreed to invest up to £2 million a year up until 2027 to accelerate bringing new products to the market. The strategy is to build on our existing product portfolio in areas where we really excel and bring the business to profitability. We've got a mixed model strategy of licensing in external technologies and building in our own products. Licensing in products can accelerate product launches, enabling us to be responsive to new market opportunities. Building our own products in-house ensures that we have the best-in-class products designed specifically to meet our customer needs and delivers higher margins. The strategy has progressed throughout 2025, and we've had our first 2 product launches this year. The LightBench Discover has been built by the Canadian team as part of the Ranger technology portfolio. Launched in July 2025, specifically to support long-read sequencing customers. This was done in partnership with PacBio. This machine is an integrated single benchtop solution that replaces the need for multiple instruments. It's got 3 functions all in this small box. First of all, it can analyze large fragments of DNA up to 150 kilobases in size. It can carry out size selection so that they are taking forward to sequencing the most impactful and important elements of the DNA for analysis. And finally, it also quantifies that DNA, replacing multiple other instruments that they would otherwise have to buy. We've also just released in Q4 a new APAC-focused NIPT solution. This is a regulated NIPT workflow to meet the changing needs in the APAC market. It's automated, high throughput, and uses this Ranger technology for fetal fraction enrichment. What else is coming up? Well, we continue to build out each of those pillars. The instrument portfolio will be building out with new functions and making more of the functions each instrument already has. So LightBench Discover is planned to expand into other long-read technologies, such as Oxford Nanopore, to enable their customers the benefits that PacBio customers have already seen. We want to broaden the cell-free DNA applications beyond NIPT, particularly focusing in oncology, where circulating tumor DNA could benefit from the same functions that we've seen with fetal DNA. And finally, we're building in new RNA quantification and size selection kits to broaden the utility of the instruments beyond DNA. And now the precision medicine roadmap. Yourgene DPYD assay was launched with great success. We're now updating that assay with a new assay called NOVACYT DPYD. The test is to prevent patients from a chemotoxic reaction to chemotherapy. Last year, AMP released new guidelines on DPYD screening with a much broader range of tier 1 and tier 2 mutations to cover broader ethnicities. Our new NOVACYT DPYD assay will include these new extended markers and meet the current screening guidelines. Reimbursement in Australia is due this year for DPYD testing, and our current kit is the only TGA approved test on the market in Australia. In development, this test is expected to launch in H1 2026, and we'll be delighted to be working with our Australian distributors to make that available for the newly reimbursed DPYD test in Australia. There are other additional assays that we're investigating to add to the precision medicine portfolio, which include other pharmacogenomic tests and also oncology treatment selection panels. And finally, the reproductive healthcare roadmap. We'll soon be launching a spinal muscular atrophy test. This is a rare inherited genetic disease that causes progressive weakness and muscle wasting. Some countries already offer SMA testing in their newborn screening programs, and this test will allow them to use our newly launched test in a very cost-effective and effective way. Additional products that we are investigating include an assay for an inherited blood disorder focused on the APAC market needs, a newborn screening panel that covers a range of diseases screened for at birth, including cystic fibrosis, SMA, and other tests. Our cystic fibrosis test is already very popular, and we'll be utilizing next generation sequencing technologies to update that and include more markers in the future. New next generation of NIPT solutions that offers additional clinical content and ensures that we remain competitive in an ever-changing market is a very exciting space for us and something we are now looking to roll out later in the 2027-2028 period.
Thanks, Maria. Thanks, Joe, for giving us a flavour of how NOVACYT will be successful in the future. Look, so what does this mean from a financial perspective? So we're now 3/4 of the way through the shaping up. The H1 results are a good indicator of the run rate for the full year results. However, we are expecting to see a slight uptick in H2 revenue, driven by the demand for our instrumentation, where we've seen a number of orders for our recently launched Lightbench Discover product. We expect our EBITDA loss to reduce compared to last year, and that will be helped by an improved gross margin. And we expect our cash outflow to reduce in H2 and be lower than the 6.8 million cash outflow that we saw in H1. And that's largely as a result of us completing all of our site consolidation program of work, and therefore we won't incur further one-time associated costs. So what are our goals for the next few years? Well, we have 3 key KPIs. So from a revenue perspective, we're aiming to deliver double-digit growth. And that's why we've invested heavily into our R&D to accelerate bringing new products to the market, some of which were covered by Joe earlier in the presentation. From a gross margin perspective, we want to maintain a 60% plus gross margin, and that's vital to improving our EBITDA position. Now, since the time of the Yourgene acquisition, the combined business has delivered an underlying gross margin that's greater than 60%. So we're confident that we can continue to deliver this, even with some of the price pressures that we're seeing in different regions. And from an EBITDA perspective, our goal is to reach EBITDA profitability as quickly as possible. We've obviously materially reduced the cost base of our business over the past 18 months, but now we need to grow the top line to deliver that profitability. We do believe we can get there without the need to raise further cash due to our strong balance sheet position. And finally, you may be aware that Singers, our newly assigned joint brokers, have just produced an initiation note on NOVACYT. Their financial projections can be found on Research Tree, which is a paid-for site. Walbrook, though, our PR firm, will be producing a summary of their research note, and that will be available for download. Back to you, Lynn.
Okay, so we're coming to a close now with the presentation. I'd just like to again express my thanks for the executive team here today, who have presented their strategy, their view from the bridge, and what they hope to achieve over the next couple of years. I'd like to thank all of our, NOVACYT employees across the world who are working really, really hard and have continued to work really, really hard to deliver the quarter-on-quarter growth that we've seen over the last 12 months. And as you, potential shareholders, existing shareholders, I'd just like to give a summary to why I'm going to invest in the NOVACYT Group. What do I think this group, why is this group exciting? Why does this group stand out against some of its peers in the market at the moment? Well, we've got real stable foundations. As I've said, we've spent the last 18 months building a real strong operational center of excellence here. We've got our cost base reduced and under control. Our cash burn continues to reduce on a monthly basis. We've got capacity in our fantastic facilities here on the Science Park in Manchester. And as I said, a real strong foundation for future growth. Our revenue growth is on an upward trajectory. Having just finished our last quarter at the end of September, with a consistent high gross margin performance, it feels as if the business has really stabilized over the last 18 months, has built this real strong foundation and is ready to leap forward now. And we look forward through the introduction of our MPI and new customer wins to continue that journey. The business has been fortunate post the COVID pandemic to have enough funding to reach EBITDA profitability. We understand that a lot of organizations are not as privileged as we are, and we consider that to be one of the major, strengths of our foundations. Is we can use current cash to support innovation, to bring new products to market, to drive and search and win new customer business, and support the growth of our organization, and we can fund all of that ourselves. We've got established customer bases in key markets who are adapting our new products. So it's brilliant to see the new customers joining our organization as we bring new content into the market. But obviously our first port of call is to go to the existing customers. And we've been lucky enough to be serving those customers either through Primer Design or the old Yourgene business for a long, long time now. So making sure those customers are kept close, and that is certainly being achieved, under Maria's focus of having more regionalized salespeople looking after the customer bases under a globalized sort of commercial footprint. We've got the strong MPI pipeline for growth that's going to drive us through to profitability. The Lightbench Discover platform that we've launched this year we sold quite a few of those in just the first 2 months of the product being available in the market. We've grown a healthy pipeline as people want to hear about this exciting technology. And I'm sure that the new projects that Jo and her teams have been working on, and it really is a combined team effort. It starts with understanding what the customer needs, which comes through commercial. Then it goes into a gateway process where we decide, can we do this? Have we got the capability? Have we got the freedom to operate? Is the market ready for this technology? Then we go into the sort of development phase where, our scientific team are very busy running lots of experiments to make sure that we get the best possible product. Then we get it through regulatory. I mean, the list goes on. It's a real team project here at NOVACYT. And again, delighted to show that we can show and establish how we've done that already over the last 12 months with the product launches that we've brought to market. And I look forward to the team successfully executing the forward plans over the next 2.5 years. Robust commercial strategy for each product portfolio across clinical, research use only, and instrumentation. These are 3 different markets. They require 3 different messages. They require 3 different approaches. And under Maria's leadership, we've put that in place now and have a very robust commercial strategy that looks after existing customers, making sure they're feeling great about the products and services they buy from us, and hands down new customers, trying to excite them with either our new technology or a wider portfolio of products to bring into their organizations. And as an organization and as a set of shareholders, we have the ability inorganically to accelerate this path to profitability through our potential M&A opportunities. So I'm sorry that we haven't been as vocal as maybe you would have expected us to have been over the last 18 months. Hopefully what you've seen is a team that's been working really, really hard to build a really solid foundation for this new, empowered NOVACYT group. We've got great products, we've got great people, we've got great customers, and the market's starting to switch on, post-COVID and recover from that slump. So this is a really exciting time. I'm delighted to be able to sit here today and give you an update, and we look forward to giving you further updates in the future as we continue to execute and deliver our plans. Thank you very much for taking the time out today. Speak to you soon.